Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. Yo, Ma, it's Monday, the 24th of March. There's one more Monday in March, as it turns out. There's like 8 Mondays in the month of March or something like that, Dan. But it's 11 a.m. on the East Coast. How are you?
Yeah, they snuck one in with that March 31st guy.
Snuck it in.
Yeah, they did kind of sneak it in, because if it was a leap year, you wouldn't get that,
I don't
right?
know. I honestly have no idea.
I'm doing okay. You and I start this some days and say really interesting market. Others day we say not so interesting, and then we come up with something. We make something sort of interesting. But today is one of those real interesting days. Do you agree
I
with
agree
that?
with that. No doubt about it. And we're sort of getting a little bit of follow through here. And
by the way, the follow through last week snapped a 4-week losing streak, but on the week it was just up a smidge.
Smidge is the technical term. By the way, if you have any questions, blow up Amanda's inbox. She's back from her, what do they call that thing?
The baby moon.
Baby moon in Puerto Rico. Hopefully people saw her there and reached out to her. That would have been fun. I'm sure she would have been thrilled by that. But let's take a look at the first chart, because this is something, we've been talking about, the potential to sort of trade back up to this trend line that's been broken, and or the 200-day moving average. Broke the 200-day moving average, traded lower, traded back up to it. Here we are. This is sort of the line of demarcation, I guess. And, we'll see how it plays out. Do we close above it? Do we close below it? Do we close on it? I mean, that's the thing that I think market participants are trying to, I don't know, sort of come to grips with, I guess.
Well, over the last couple of weeks, we've been talking about this, and, the headlines every day, they were just negative, right? And the sentiment indicators were getting more negative. And we saw some stuff where at the highs, a month and a half ago or so, like the kind of positive sentiment readings were off the charts. And then, 4 weeks later, they were, about as negative. We're seeing headlines about as negative. And again, this is one of the things that I think is really interesting, this kind of disconnect between what some of the indicators that most people don't look at, that they don't hear about, right, until they reach those sorts of levels. A great example was that SOM indicator. I bet you 99% of market participants did not know what that is. I certainly did not. You were on Fast Money, really funny. You quoted it, word for word, basically the way it was. And I was like, almost fell out of my seat, because I was trying to figure out what the hell that meant. But we went from overly exuberant, right, to overly pessimistic. And your point about the 200-day moving average is a really important one. Why? Because a lot of algos look at it. A lot of folks who are trained at technical analysis look at this. So we had a break for a very short period of time to the downside, and here we are on the upside. Amanda can pull up the 5-year guy with the 200. Love for you to kind of parse that one out, because again, if you look at the breakdowns, they're short-lived other than 2022.
No, and if you go back to, I guess, last summer, and you can see we violated it, but we were very quickly back through it and off to the races. And then again, you saw that, well, actually it's 2023. Again, you saw that in last summer, traded down to it and bounced. So here we are. And I think most people say, what, we've seen it before, a violation and or a touch of the 200-day moving average, only to go back through it on the upside in a meaningful way. And the same thing could theoretically happen here. For some reason, I feel it's a little bit different this time. I think there are other forces at work. But if you just look at this chart, you say, wait a second, Dan, wait a second, Guy. We've seen this movement before. And if you are basically able to take the noise out and sort of just focus on levels, you've been rewarded handsomely. The problem is, I just don't think it's noise at this point. I think there's some real fundamental things going on as well.
Yeah, and I think the fundamental point is important, because you and I are of the belief that the tariff situation was something that it was something that, for whatever reason, the White House and the Treasury, they wanted to kind of make this thing a thing. They basically said, we got to go through a detox period. We're not worried about the stock market, and it reminds me a lot about 2018 and the sort of trade war that was kind of concocted back then. And again, there was tons of exclusions that were made. There was, it just felt like a problem that they created. And I think said this earlier to me, and a problem that they could come up with a way to solve it. And that's apparently what they're doing. That said, all the news agencies are reporting about targeted tariffs on April 2nd, which Trump has called Liberation Day for the U.S. economy, so who knows? It also reminds me, Guy, a little bit of the kind of ripping up NAFTA and creating the USMCA that looked a lot like NAFTA, right? And now the second time around, they're trying to do the same thing. I mean, this is really where a lot of these tariffs come from. And the fact that they kind of targeted, Mexico and Canada first, which is something that we've been saying, just seemed a little ass backwards, Guy.
Yeah, and people will, say you're being dismissive, Guy. And I've said it, and I'll say it again. I do think they're masters of creating a problem that may exist in some way, shape, or form, blowing it out of proportion, and then solving said problems. And the market and or market participants sort of basically getting excited about that. And there's, whether you like it or not, there's sort of a brilliance to that, and we'll see if it works this time. But what's interesting, the first question comes from Gary Webb, and if Amanda can throw it up, this goes to the next chart that we had in line, which are yields. And what's going on here with this 10-year yield back above 430 or so. And we talked about it a little bit on an earlier show, by the way. That's the Risk Reversal podcast. We didn't get that granular then, but we will here. And one of the things that I thought, Dan, was as the yields went lower, as the market went lower in some of this flight to perceived quality, and now as risk appears to be back on, yields are sort of left to their own devices and potentially going where they should vis-a-vis some of the fundamentals. That's my take on it. Now, I'm not suggesting I'm right, but that's what I think is happening here. So some of those forces that I thought were at work remain in work in terms of yields going higher. And at least for today, you're seeing it play out.
Yeah, another thing that we've been talking about over the last few weeks is this was a narrative that became sort of prevalent over the last month or so as the stock market was selling off, that the administration is deliberately trying to tank the markets, tank the economy. You heard Treasury Secretary Bessent talking about they're targeting yields on the 10-year. They're not, worried about the stock market. If it has a little pain, that's fine. If the economy has a little pain, I just wasn't a buyer of it. And especially when you say, well, we saw so many stories. Well, the first administration, the Trump saw, the stock market making highs as somewhat of a report card on how he was doing. And he would tweet at the end of the day, every new high, be like, you're welcome, America. Your 401ks are welcome this summer. I just didn't buy that they were only focused on the 10-year, right? And so to me, there was a Trump put in place. You know what I mean? So they were talking about what was Fed Chair Powell's put, what was the Treasury Secretary's put. There was always going to be a Trump put for the stock market, because having the stock market careen lower, getting to let's say 20% lower or something like that, just wouldn't have been palatable for the way that we know he thinks. Does that make sense to you?
Makes sense to me. And look, again, we'll talk about it again. I thought 5,700-ish was going to be a bit of a line in the sand in the S&P. And that's, by the way, we're trading higher than that now, but we traded below it. And we traded down to 55, I think 05 at some point was the low. And I only mentioned 5,700, not because it's some magic level, but it was sort of the level that we saw right around election day or thereabouts. And, in terms of just sort of earmarking and benchmarking something, that level is probably important in administration. You don't want to fall too much below that level or risk losing, I guess, some of the faith of the voting of the public at large. And here we are basically back to levels that we saw in and around election day. And I think that's why there's going to be sort of this push me, pull you around these levels. And we also said that, there's a very good chance you trade it back up to 58.35, 58.50, which was prior support. Prior support becomes resistance. But I think your point is well taken, that as much as they say that they're not focused on the market as much as they were in the prior administration, there's still definitely a focus around it.
Yeah. And one of the things that you just said is interesting. And it's interesting because of the timing a little bit, right? So two things. We had this triple witching expiration on Friday, and then we have the end of the quarter coming next Monday, one of those Mondays that they snuck in there, Guy, just to kind of, and, I say to myself, okay, Mike Wilson was talking about this for Morgan Stanley in his note out this morning. There's some seasonal factors in effect, right? So as you get into quarter end, sometimes there's a little bit of window dressing interesting, you think about it in that capacity, like PMs just want to kind of push the market up a little bit. So see if they can kind of outperform what was a pretty negative quarter, in the S&P 500. But you said something about the fundamentals might have changed, or the fundamentals as it relates to some of the big drivers. And Mike Wilson also mentioned this, is that some of that seasonality might help positive earnings revisions, right? So if we got really negative about the drivers of the stock market performance, which was this fateful 8 that you like to call it, so that's the Mag 7 plus the Broadcom here, if you were to see estimate revisions, if you were to see negativity really, like I guess crescendo after those earnings, we've talked about that Amazon and Google and Meta were trading at all-time highs into their Q4 prints. And, they were kind of fine, except you saw revenue deceleration and you saw spending go higher. So if you see revenue reacceleration in the guidance for some reason, then people might not be as worried about those CapEx numbers that they get. And the last thing I'll just say before I kick it back to you is that what if these companies try to kind of get some of the news out about CapEx? They did it last quarter. You know what I mean? By the time you got to the results, the CapEx numbers were already known for the most part, at least with Microsoft and Google.
Yeah. So a lot obviously to decipher or to interpret that and try to synthesize. But, companies will definitely try to get ahead of these tariffs. I mean, we've seen it. If you watch the news over the weekend, they interviewed all these different car dealerships and they said they've gotten stocked up on inventory ahead of the tariffs, which is great. But then you hope if you stock up on inventory that there's going to be the demand that you anticipate. I mean, a lot of it, stocking up and getting prepared for something is great. But if the outcome isn't what you anticipated, it sort of doubles a potential problem, or it makes a problem out of something that might not have been there. And I think we've seen it with a lot of these retailers in terms of inventories, trying to get in front of what they think is going to happen, and only maybe to potentially be thwarted by their customers who may not want their merchandise. And I think there's a chance for that happening. I don't see a reacceleration of earnings or revenue. That's just me. It doesn't mean I'm right. I'm hard pressed in this environment to sort of figure out how that happens, but anything's possible, and I think right now with the market being higher, that sounds like a smart argument. But conversely, if the market's down 80 to 100 S&P handles, it doesn't seem as likely, right? I mean, I think a lot of times we try to sort of back into an answer based on, I'm not saying you're doing it, I'm not saying I'm doing it, but the market participants or pundits try to back in an answer based on where the market is that day. And I think the only thing that's changed from my vantage point is the fact that we're getting a bounce in the S&P.
Yeah. The inventory thing is a really interesting one, right? Because we're not going to really know until we see some of the margins from the companies as it relates to, Q1. And, this was probably something that only affected some of the ordering or for like the last month or so, like getting in front of this kind of April 2nd date. But it brings me back a little bit to some of the problems in 2022. We did not have an economic recession, but we had an earnings recession. The earnings recession by S&P 500 companies had to do how they were managing supply chains, how they were managing inventories, right? Once the economy started kind of coming back a little bit. And Micron might be one of the latest examples, when you talk about some of the inventory issues that they had with NAND flash, and then some of the yield problems they were having with their high bandwidth memory. That's the HBM that goes into a lot of the AI servers. If you're having low yields on your growth product, right, which makes your product maybe less interesting, and then you're having inventory for the product that goes into consumer electronics and stuff, and then you're having some wage pressure, you're having like a slowing economy, which is some of the stuff that we saw, discretionary in particular, you're having issues with overseas markets because of tariffs. That could make for a really nasty sort of, I guess, guidance environment as we get into Q1 earnings. So again, we don't know, but it'll be really interesting to see if that's a little bit of a curveball.
I agree with that 100%. I mean, that's going to be the rub, right? You're not going to know until you see margins and you're going to see what their inventories level are and what the sales year over year sales, whether it's a positive or negative, and then obviously the build or decline year over year in inventory. And my instincts suggest at a lot of these retailers, we're going to see a build year over year in terms of inventory, but we're going to see a subsequent sales growth decline that will probably mean there's going to be pressure on margins. That's just me trying to read the tea leaves. But, you don't really need to listen to us in terms of the economy. You can just look at some of these analyst calls. And, the call of the day today, Dan, is out of Piper Sandler. And, they lowered their price target on Lowe's and Home Depot. Now, with that said, the price target for Home Depot is 418, and you're talking about a stock right now that's trading 360. So that's still probably 15 or so percent higher than we're currently trading. But the point is, I think a lot of these analysts are starting to come around to the notion that, hey, wait a second, maybe there is a bit of a slowdown going on, and maybe some of these retailers that have benefited from a number of different things are going to start to face some headwinds.
Yeah, I think what's interesting about Home Depot and Lowe's too is like they don't always act the way you think they should given the certain environment that we're in, right? So you have a housing market that's locked. You're come off pretty hard from like I think it was a 30-year mortgage was like 7.37 last year. It got as low as maybe 6.6. And so, okay, does Home Depot and Lowe's, are they supposed to sell off if you start to see, the housing market kind of, get out of that freeze that it's been? I don't know. When people buy new houses, they spend a lot of time at Home Depot and Lowe's, you know what I mean? Like doing whatever it takes to kind of get in that place. Or if the market is locked, maybe you're fixing up. This is something that we saw during COVID. These stocks don't act particularly well. And from a technical standpoint, if Amanda wants to pull up the 5-year chart, you can draw a line basically from the 2023 lows, and you can kind of attach it to the levels that we saw in 2024 when there seemed to be in a bit of an uptrend. I mean, we blew that out, like that technical level. Now you may say, well, that's not that important. I want to see what happens. But we were down 20% quickly, which is kind of the performance guide that we saw in big tech stocks, this fateful eight, as you like to call them. And so if we let's pull up the XHB for a second. When I think about why are you smirking, Guy? I mean, seriously,
I've never, because I don't, me. I know you say it to create, trying to gauge or create a
thing that
some
doesn't
sort of
exist. A thing that
it's not my thing. I mean, I think it's great. By the way, we've said 100 times that you were the creator of the MAGA complex, right?
Yeah,
I mean, you're the one that put it on paper, and then subsequently, then President Trump sort of came up with that same idea. So you're definitely a bit of a trendsetter here. I'm just not.
But the fast money people loved it too, like our fans, because they were calling it the FANG. And I went to the MAGA. It was Microsoft, Apple, Google, and Amazon. And at the time, they were like the only $1 trillion, market cap stocks. Now we have the fateful eight. When Broadcom in December joined the $1 trillion club, I thought it was important to kind of give them a little love. When you think about the home builders, though, here, Guy, they're down at their lows 22%, and they haven't really bounced.
No, this is, again, not the greatest constructed ETF. We talk about it all the time. So if you want, there are 3 or 4 home building stocks we look at all the time, whether it's Toll Brothers or Pulte Homes or DHI, you take your pick. They're all going to look very similar. So Amanda can throw whatever there you go. I mean, there's the Toll Brothers chart. You see how long it took to make those new highs, and you see how quickly we basically gave it back. Most of it we gave back over the course of a couple of days. And now here we are. And people will say, well, wait a second, if rates start going lower, it's going to be beneficial for some of these home builders. But if you look around the edges, what you've seen is average selling prices for a lot of these home builders, whether it's the middle end or the high end, have been coming down. And that's the first time we've seen that in quite some time. So if you were to see an uptick in unemployment rate, which I do think we will see, these home builders, a lot of it's predicated on confidence and a robust job market. And I think if people start losing their jobs, that inventory that hasn't made into the market will surprise people at how quickly it does.
Yeah, and so KBH reports after the close tonight, so that might be a really interesting one, and that it's up 2.5% today. But we just showed the XHB, which was down at its lows 22%. This thing, is up 2.5% today, but at its lows last week, it was down 33%, right? And so that is interesting to me. You just mentioned wages, you mentioned employment, and let's pull up the sectors here, the S&P 500, and you were looking at this through the lens of these sector ETFs. Up the most today is XLY, because a large part, again, you want to talk about a poorly constructed ETF. I think Amazon and Tesla make up 40% or 35%, which brings me a little bit. So that's consumer discretionary that's outperforming. You have communication services and tech doing well. Industrials, I think that probably has a lot to do with Boeing. I think the financial sector, not that interesting. And then you look at all the way down there, you look at some of the defensive utilities, healthcare, and consumer staples, and they're all up less than 1%. But Guy, this brings us to a question about consumer discretion. This is from Jeff H. Jeff H. why is Tesla up so much today? Right now, I'm looking at this thing. It's up nearly 10%. It was up 5.5% last week. Guy, give it to us. Why is
Well,
Tesla up so much
throw up
today?
a chart. I mean, if you look, we traded down to levels that theoretically should have been support. I mean, if Amanda wants to just draw that horizontal line across those bottoms, yeah, right there, you can see. I mean, that was a previous low that we saw in the fall that we bounced off of into the election, and we round tripped it. And we had talked about this late last week. I thought sort of 235 to 240 was a bit of a support level. It obviously overshot that. And I said the other day, I think we could easily trade back up to 285, and nothing has effectively changed. And right today, it appears as though that's happening. So it's not like magically the fundamentals got better in Tesla. And I don't think magically the fundamentals deteriorated as much as that downdraft suggested. I just think we're sort of finding our way into sort of this equilibrium. I do think the fundamentals are challenged, and we're going to hear more about it the end of this week or next week in terms of deliveries, which I don't think are going to be great, but I think the market anticipates this. I think we're seeing a bit of a relief rally here that, to me at least, makes sense, and it's something we talked about last week.
Yeah, and again, just because the sentiment got so bad, the headlines were so bad, the stock was trying to put in a little bit of a consolidation right around those gaps, right? So again, that all made sense to me. It'll be really interesting how it does that 200-day moving average, especially as we get to next weekend into March 31st, because they're going to release their delivery data. And, the street is still really high on that, guy. Some analysts have taken their numbers down below 400,000, some as low as like 320. I think the Baird analyst had that number. We tracked this guy named Troy Teslike on the internet. He's got a Substack, and he's really good. And so usually the analyst community is following him. Here, guy, this is another poorly constructed ETF, but this comes from Eric Lancelotti, and especially
With us every day, Eric.
Yeah, he's the man. It's about XLE. And one of the things, if I'm just looking again at that chart with the XLE, it's up about 1%. This thing's been really volatile. Eric's question: what do you think of XLE here, considering Trump isn't afraid of being hawkish around the conflict in Gaza? Good question. The ceasefire was just broken there. There's, more bombing. And again, it looks like that might not ever happen, a ceasefire there.
Yeah.
So thoughts on XLE?
By the way, throw up JS's question as well, because his question is about Chevron. So if you look at, I want to say 50% or so of the XLE, maybe a little bit more, Conoco, Exxon, and Chevron. And here we are at 93 and change. And if you do a longer term chart, Amanda, I mean, you'll see this has sort of been sideways for a long, long time here. And if you go even longer than that, you'll see the all-time high is probably just north of 100 or so. So, to me, it's pretty impressive how well the XLE has been hanging around here. I mean, a lot of people will say, well, it should be hanging around given sort of the backdrop. I think the XLE is a buy here. And if you want to play individual names, the one that I like the most is Exxon, which I think is trading around 115. And, geopolitical is important. It's the fundamentals that make a lot of sense here. And they're still sort of very compelling in terms of, if you just look at their balance sheets, but more importantly, just valuation still makes a lot of sense. So I think Exxon can surprise people here, which means by definition, I think XLE continues to go higher.
It's interesting, though. Exxon went from a 52-week low, I want to say it was about 3 weeks ago.
Amazing, right? How
Right
quickly
to
that
this
happens.
moving out. Let's pull up crude oil for a second here, guy. Again, you maybe can kind of answer a question from Dan N, because again, why would
that's Dan N. See, now I get it. That's you.
There you go. So look at that kind of, we've been talking about that 65.5 level for, I don't know, a couple of years or something like that. But look at like the lack of bounce there and the way that the XLE has bounced off of those lows in the last. So this is really interesting that those stocks trade independent of the underlying commodity.
They should. They're not necessarily. I mean, I know a lot of people think they're tethered to the price of crude, but crude somewhere between 60 and 75. I mean, these companies should theoretically do really well. Obviously, I understand there's a want to trade these names on the back of the commodity, but now that seemingly crude has been sideways-ish since, I don't know, the fall of last year. I mean, you've had some moves up and down, but we've basically been at the same price. I think the underlying the equities are starting to figure it out and say, wait a second, these are very profitable companies in this environment. And if you were to get some sort of renewed geopolitical risk, you could very easily see us back to the low 70s, which is where the 200-day moving average comes in.
Yeah. And so this is also interesting because it's just kind of a segue as we think about crude and the relationship of that with the dollar. Here's from Jeff H. Guy. Not sure if they see my questions, LOL. Hey, you know what, Jeff H., we do see your questions. And look at us. We're trying to make a point of answering more of that. We promise we will do that. We appreciate you guys being here. We appreciate the engagement. And so we are going to do better with that, Jeff H. But the question is not sure if the guys, well, that's not the question. That's the statement. But thoughts on the dollar going lower, question mark, Guy.
Yeah. So, I mean, again, where we just traded down to was a natural support level. If you just, again, you can draw the horizontal line across that November-ish low, and it makes sense. I mean, yeah. So you can see, you go back and look, if Amanda just wants to put that horizontal line in and leave it there for a second, and you can say, okay, why do you look at something like this? Well, look at what happened. I mean, it was above that line for quite some time. Go back to you even go back longer than that, Amanda, and incorporate the summer. Yeah. And you can see how it traded around there. I mean, we traded down to it and bounced. We traded through it, sold off. I mean, so this is a definite line of demarcation. We actually talked about it. And then if you want to say this in terms of the levels, I mean, we're bouncing up to the 200-day moving average here. So I still think there's going to be a subsequent move lower to the line Amanda just drew around 100, which is nothing technical or nothing magical about 100. Other than that, it's been previous levels of support.
Yeah, I mean, I would say, and probably Carter would say, maybe if we can get him this week, this is a pair O2s, Guy. If you think about it, at let's call it 104.5 or something like that. If the high was 110 and that low is 100, like you take your pick why you think this, might move one way or the other. And if they look at the dollar index and what percent, let me see if I can find this. What percent is the euro? And we know some stuff.
36, I think, but I might be wrong.
Yeah, but so again, I mean, I find that one harder. You got to have a macro view right now to kind of lean on the technicals a little bit. So again, great question. We're going to do a better job of answering them. Let's go. We got something here. Let's go to
a bunch of people asking about gold. The last one I saw was from Jim Wise, and it's gold, silver sort of peaked out here. And my answer, I think what my answer is. No, I don't think so. I mean, can we see a little bit of a sell-off in this up channel that we've been in? Yeah, I guess. But what I've noticed about gold specifically is the sell-offs are shorter and shorter in duration. And whereas they used to last a couple of weeks, now they're seemingly only lasting a couple of days. And when you see big risk off days in the equity market, you're seeing the same in the gold market, but then it subsequently sort of gets back on solid footing. So the gold trade, to me, Dan, Jim, anybody that's asking, and Arlie as well, is alive and well. I don't see anything that's stopping it right now.
Yeah, I mean, I'm kind of in the other camp, Guy. I like go back to that uptrend channel that they had there. I mean, by the way, you can draw that uptrend from that early 24. You see where it inflected off of the 200-day moving average, right? And if you look at that, I mean, when I see these guys, you better have a good reason why it's going to break out above that, especially after the move that it's had from 1750 up to 3017 or 3018 where we have. But, the pullbacks have been buys, right? So if this thing came back to 2750, I'm a buyer there, which actually leads us, and these have nothing to do with each other, but to our chart of the day, which is Starbucks, because this is interesting to me. If you look at the 1 year, and this kind of popped out to us on days like today, where there's just a sea of green on my FactSet machine, I like to see what's going the opposite way. And this was one of them, and there was a ton of enthusiasm. All right, this is an amazing chart. So that gap lower basically sealed the deal for the former CEO, right? It was just a horrible quarter, horrible guidance, and then the thing's banging around near 52-week lows, and then you have that announcement of a new CEO. Where did he come from? Chipotle, right?
Chipotle Mexican Grill.
Right. And so you see that gap, and you and I both thought it was interesting that it was able to hold those levels for months, right? And then kind of go sideways. And then we saw this move earlier in the year, and then the results, and it's making new 52-week highs, the quickness in which that came back. So you look at that uptrend, you look at that 200-day moving average, and you might say to yourself, this is a good level. Let's look at the next chart. All right. So there's that uptrend, right? To me, I want to trade that off that level. The same way I'd be a seller of the gold off of the upper end of that up channel. Here we are very close to the bottom end of that. And so if things are just trading technical in and around what we're seeing in a volatile market where we saw a VIX at 25 just a week and a half ago, like I love these trend channels and I like to use them that way.
Yeah, well, we're going to show a chart of Facebook in a second. And what I said about Facebook probably holds true here in Starbucks. If Amanda wants to put that original chart up, I mean, if you've been looking for a level to buy the stock, I mean, it doesn't get much better than this. Now you can say we didn't get to the uptrend line. Okay, if you want to split hairs, but now you see we're right at the 200-day moving average, basically. You see that uptrend that's been in place since last summer. This, to me, is the entry point that you've been waiting for. So I'm with Dan on this one, which, by the way, go to the Facebook chart. And if you listened to us last week, we said categorically that if you have been waiting to enter this name, it got down to the 200-day moving average to the penny, as Carter would say. There's your entry point. And that that uptrend line had been broken. We probably trade back up to it. By the way, trading back up to it on time erosion probably gets you close to $650, which, is a nice little trade off that 200-day moving average, Dan.
Yeah, and so this is one where let's throw up the fateful 8 for a second here. Amanda's got a nice little chart, and on a year-to-date basis, look at that. Okay, that far column, like that's to me one of the more interesting things about this group of stocks, right? And on a day like today, I love to see again what is outperforming, what is underperforming. We have an S&P up 1.6%, we have a NASDAQ up 2%. I see the Apple up 35 basis points, and I see Microsoft up 45 basis points, and you see all the other performance. And this is we took a screenshot of this before we went on, so some of the stuff that you're seeing has changed a little bit. But not too much, right? And so like the Tesla is up 9%, and some of the other ones are probably in and around the same levels. And so, my Meta is clearly outperforming on the year. It's outperforming the rest of the names other than Tesla. It tells you that this is the one where people feel most comfortable with, not just on fundamentals, but also valuation. So I want to see how these stocks act for the balance of the day and if the market can kind of hold those gains. But I also believe that the Faithful 8, they're the only ones that can kind of lead us out. I mean, like really, when I think about as far from a performance standpoint, from an earnings standpoint, this is the prior leadership. It basically doubled up the losses in the S&P across the board. If you take Tesla out, which was down nearly 50%, the other ones were all down about 20% from the recent highs.
No, it makes sense. I mean, math suggests it's going to take those names to sort of get us back. Real quick before we get out of here, Scott's asking about Abbott Labs, which I haven't looked at it a while, but I just pulled it up. And in December of 2021, we traded up to about 140. We recently just traded up there again. I mean, the armchair technicians like myself would suggest a potential bit of a double top here. I got to look at, there you go. I got to sort of look and see valuation wise. I mean, if I'm trading the stock, Scott, which I haven't looked at in a while, but just eyeballing it, you're either waiting for a move down to the moving average is about 116 or so, or you're buying a breakout above 142. I think here, you're sort of no man's land. It's just my opinion. Unless you have a fundamental view, then you buy a little here. You hope it trades down to the moving average, buy a little bit more. Or conversely, you buy a little here and then buy the breakout. So that's the way I look at Abbott Labs here.
Yeah. One last one, and I'm just going to tell Eric Metcalf, who is here with us every day. He's asking about Snap and an entry point, and we talked about it late last week. And I was thinking on Thursday, kind of about pulling the trigger on an option strategy. And so tune in tomorrow, Eric Metcalf, and we're going to take a look at that and how we might use options to kind of play that. I think our target would be a gap fill going back to August. That probably looks like, 14.5 or something like that. Looks like a nice double bottom. If you wants to pull out the 5-year, I mean, talk about, bouncing off a level here. You probably want to define your risk to those lows. But I think your upside downside is 1 down, 3 up. So we'll take a look at that, and we'll look at some probabilities as it relates to the options market. But I just want to hit that, Eric. So come back tomorrow. We're going to have an idea there.
We appreciate all the questions. We efforted to answer them all. Up real quick, Gary Webb, since I just saw it, do you think we'll hear hyperscalers cut CapEx numbers this quarter? That's directed at you. I mean, that's something that we've talked about. And I said on the show Fast Money last week that these numbers are not etched in stone. So if things continue to deteriorate, there's no reason to suggest that we won't see a reduction of CapEx?
Yeah, I agree. That's going to be the real question. I mean, like you and I have been talking about this when you say what's been powering, some of this economic growth that we saw in 23 and 24 and maybe helped avert a recession is that sort of CapEx, and half of it was, to build out data centers and the like, primarily here in the US. If a bunch of that CapEx is going overseas, all these companies need to build data centers outside the US, that maybe it's one of those things that starts waning, as far as its contribution to the US economy. But also if they cut them, to your point, if they're not finding the use cases, if customers are kind of lowering their spend on these, these public data centers and the like. So that's one I think is important as it was into Q1 guidance. When we get to Q2 guidance in just a month or so, is going to be equally important, Guy.
We appreciate you guys and gals joining us for Market Call. We'll be back tomorrow. Dan's going to have a conversation with, I think, Gene Munster later today, which will drop tomorrow. So there's a lot. We obviously had a great conversation with David Rosenberg last week, which dropped on Friday. If you haven't listened to that, you should, because he's always fantastic. But a lot going on here at Risk Reversal Media.
Yep. See you, everybody. We appreciate it. Thanks.